Welcome to the Dividend Talk Podcast, episode 252. Dividend growth investing in 2025, is it still the single best investment strategy? Happy birthday, European DJ. We're 6 years in business today.
Yes, 5 full seasons of Dividend Talk. I mean, amazing, amazing. I'm so happy. I mean, it's a bit too early on the day, but I would love to pop up a good old bottle of vodka with you. But next time when we meet each other, I'll have one ice cold for you. We'll finish it together in one go and we'll record the next podcast. So I don't know yet when, probably
Yeah,
January again, but we'll have to
yeah.
do it with an ice cold vodka. You may choose the brand. I would suggest, of course, the Polish one. But I'm getting thirsty already. But we need to celebrate. So
we do need to celebrate. I mean, it is a massive achievement. This is our sixth season, our sixth year in doing this. And I mean, let's start with some memories, really, because we got so many, and I know we put out some questions to the community, and it triggered some memories rather than questions, and we got quite a few. And I think the first one that I mean, I really loved is what springs to mind when you think of European DGI has to be bankers are beep.
bankers are wankers. But it's a fact. They are. They are. I can't. I mean, I tell you, what's the difference between a banker and a grave robber?
I don't know.
A grave robber waits until you're dead.
Do you know what? This triggered me because I remember we had an episode before, and I don't know the episode number, but you had these impromptu jokes like every 2 or 3 minutes. You just you stopped what you were saying, and you had these jokes running through the whole show. I can't remember which one it is, but that was quite funny.
Nah, but okay, I'll give you another one then, just
Go
to
on,
to
go
go
for it.
back into memory lane. Why don't bankers ever go to hell?
I don't know.
Because even the devil has standards. And there's another one I think about the only good place for a banker is high up in the tree. Yeah.
I mean, we could have a whole show with you just doing jokes on bankers, but it's not the only thing we are known for. Back in the early days, IBM was a hot topic with you, I have to say.
Yeah, the Aravind Krishna, I remember. First, he was, by this spook, this woman, this blonde woman. She messed up. And then we got a priest in from India, the guy, Aravind. And oh my God, what a waste of management there. I mean, why did he even get into AI, do you think?
I don't know. I don't
Because
know.
it takes AI to keep selling real investors the same empty promises. And we have seen that all the time, right?
Oh,
Didn't it
and
start with Watson? Was the next big
yes,
thing?
yes,
Totally
yes.
failed. Then it was it then blockchain?
Yeah, we did a deep dive on this, remember? And we went
Yeah.
through each year. And at the start of the year, what the promise was. And then at the start of next year, there's no mention of what the previous year was. It was this brand new promise that they were giving you. And yeah, Watson was there, blockchain was there, probably cloud computing's there. There's so much
Yeah.
stuff that they went through. But it wasn't just IBM. You had Bill Stinky. Remember Bill
Oh, yeah.
Stinky?
Yeah. Before we go there, so if you think about it, right, we're now a few years further. What do you really think IBM's strategy is? Long-term strategy? Is this like just a consulting blah blah business, or they've Red Hat?
Like Red Hat is their crown jewel, but it's still not a huge part of their business.
Well, they
So
acquired it, and then they need to watch out not to kill it, right? As they usually do by putting the IBM management layer on it. So when I was really deeply thinking about it, about IBM, because we fool around with IBM, yeah, but the company is around for many many decades. It continued growing the dividend, even the price went up a little bit. So if I would name their strategy, I guess with let's not think about all those weird stuff that they're all the time saying. I think it's the triple D strategy: delay, dilute, and disappear, just like their innovation pipeline.
you've been preparing for this one for quite a while, I can tell. And here I was, you fooled me. I thought you were going to be sincere. You're going to actually talk about what their strategy
Ah,
is going to
fuck off.
be. We're going to talk about AI. We're going to talk about cloud computing.
No,
Nah.
no, no. It's just the typical delay, dilute, and disappear strategy. Yeah, but then we had Intel, right? Bob Swan. I mean, Oh my God, what a waste. What a waste of a CEO. He literally brought the whole company down. It was
Yeah,
beyond repair after he left. And I made, of course, a mistake in that to think that they can come back. But oh my God, I mean, he should be really in the wall of shame of top five CEOs of the last 20 years. I mean, what a loser. And now he is somewhere in the board, right?
yeah. He's in the board of Accenture.
Of Accenture. Yeah, and you did a deep dive on that.
Yeah,
Oh
yeah.
my God. I mean, how did he even get into a board?
Do you know what? He served on a lot of boards. He was on eBay.
Yeah.
He
Well,
was
eBay is
on
also not there really anymore. Go on.
Skype. He was with Nike.
Oh, Skype is
Um,
gone, acquired by Microsoft. Okay.
yeah,
Well, we know what
Nike.
we know how Nike is doing now.
And the other one is, let me check, is Micron Technology.
Okay. And how did they do?
I think he's still on that board, so
Uh,
I'm not
but
quite
did it also
sure.
go to shite because that's his trend, right?
Probably down to Swanee. Remember that episode?
Yeah. I mean, horrible. What a Okay, so this stock also didn't go too well. He had a quick, really strong run up, like almost doubled in the last year, but also like not the top stock in the chip industry. I mean,
Yeah,
you,
but he
you have
seems to
this,
get out, don't he? He seems to
yeah,
get out before it crashes, so he
yeah,
knows when to get out.
yeah. Well, yeah, to cash in. Yeah, no, Oh my God, what a. I mean, if you get Bob Swan on the board, it's almost like already a reason to sell, right? Yeah, and then we had John Stinky from AT&T.
Oh yeah, John, not Bill, John Stinky. Yeah, remember Stanky?
And he's still
18.
CEO or not?
No, I don't think so. Is
John
he?
Stinky, I think he's still CEO of AT&T. I
Is
mean,
he?
it's maybe a really quick jump to one of the news items that I want to discuss because did you hear that
He is.
Discovery and Warner Bros are demerging again?
Of course they are.
Oh my God! I mean, again, you know what they said 3 years ago, right? Today's announcement marks an exciting milestone not just for Warner Bros. Discovery, but for our shareholders, our distributors, our advertisers, and our creative partners, and most importantly, our consumers globally. I think, how many times did they change the name of HBO already in the last 3 years?
Yeah, yeah,
I
a
mean,
couple of times.
insane. At least what they said at the time that they can't wait for both teams to come together to make Warner Bros. Discovery the best place for impactful storytelling. I mean, this was in a pre-ChatGPT era that they came up with this crap. I mean, unbelievable, unbelievable. You know what they say now? By
Go on.
operating as two distinct and optimized companies in the future, we are empowering these iconic brands with the sharper focus and strategic flexibility they need to compete most effectively in today's evolving media landscape. This separation will invigorate each company by enabling them to leverage their strengths and specific financial profiles. This will also allow each company to pursue important investment opportunities and drive, there it comes, shareholder value again.
Of course,
Oh,
of course. I
it's so
mean,
painful, right? To read this. I mean, I can't even have fun about this. It's just too painful. Imagine being a shareholder here.
I remember around that time we had lots of companies like Johnson and Johnson. There was a good few companies that were trying to narrow their focus a little bit
Yeah,
and go into what they were good at, into their core businesses. And then you had AT&T on the other hand that were doing the complete opposite and
yeah,
taking on something completely outside their scope. So I mean, a blind man would have told them 3 years ago that these were better as two
yeah.
businesses. Keep AT&T, keep the mobile networks, keep all those networks separate to what you're doing with Warner Brothers. But even at that, I don't know. I don't know if Warner Brothers is going to be a success on its on its own or not. If I'm completely
Yeah, but
honest with you.
it is just like it's insane. Yeah, because what do you think such a guy must have earned over the last 3 years? Let's say
Probably maybe 21 million, maybe I'm guessing 6-7 million per year.
it must have been really a lot. I let me check. Hallelujah. John Stanky earns about 26 million a year.
A
So he
year.
has, yeah. He has earned around 76 million in 3 years.
Wow.
Yeah, the only one that earned more from this deal was probably McKinsey or something like that, that brokered these mergers and demergers. I wonder if he has disclosed that he has a lot of shares in one of those mergers and acquisitions firms, because this is crazy. I mean, he gets like, yeah, his base salary is around 2.4 million. All the rest is bonus and stock awards. For what?
Yeah, yeah, for exactly for what? For
Yeah,
cutting the dividend.
I'm cutting the dividend, doing a brilliant acquisition of Warner Bros. Then forcing Discovery, let's say, to take it on this asset, and now to let it demerge again. I mean, okay, this last one is not under his guidance, but it's an outcome of his strategic foresight. Let's call it like
Yeah,
that.
yeah.
I mean, we have some horrible CEOs there in those companies, right? And they just continue to get away with it. It's amazing.
True, true. We call them horrible CEOs, but here they are making tens of millions a year while we're sitting here not earning tens of millions a year. So maybe they're looking at us just laughing, going, "Yeah,
Yeah,
we're who's the silly ones?
but
Maybe it's
but
us."
this is an honest job, right? Hosting the
Of course.
podcast.
Yeah. Held accountable.
Exactly. We hold ourselves accountable.
And what about then one of our famous slogans? You can't borrow conviction. We both have hoodies. I have a hoodie with this on that I will be traveling with
Oh,
tomorrow. You can't borrow conviction, but I really do love that saying. I have to
yeah.
admit, it's one of my favorite sayings because it is so true.
I
It's so
think when
true.
I die and you're still alive, you should tell my wife it should be on the stone. Yeah,
I'll
like on the
try.
cross. Yeah, yeah, just where I'm lying there peacefully under the sand, you can just put you can't borrow conviction on
I
there.
put a little plaque. Put a little
Yeah, a
plaque
little
there.
plaque, yeah, and then with a QR code to the Dividend Talk podcast. Yeah, why not? The
Free
knowledge should live
advertising.
on, right?
Yeah,
We are not going to delete the episodes.
yeah, true, true. I'll keep that in mind, and vice versa. Vice
Yeah,
versa.
you would
We'll have a
like it
little.
as well.
Yeah, of
Do you think your
course, of
wife would
course.
agree to it? Like subtle
Oh,
somewhere?
100% she would. She'd probably make that front and center, if I'm honest.
I'm sure that what I will do, I will in your local town in Waterford, I will do a crowdsourcing, and I will get you a tomb, like on the graveyard, like the biggest one, paid for by dividends from the community. And then there will be on the top of the tomb, below the roof, like in Greek style, will be written there, "You can't borrow conviction."
Oh, nice,
Yeah. And then
nice.
somewhere on the side, there will be somewhere like "Bankers are wankers."
Yeah, in Latin or something.
Yeah, in Latin. Yeah, in Latin. Yeah, yeah. In the direction to the financial district in Ireland.
Which would be Dublin, so it'd have to be north of
Yeah,
here. We can figure
exactly,
that out. Yeah,
exactly. Yeah.
yeah. And then one of the things that was brought up to us is that we brought some great stocks to the community, and I mean, a lot of people have said that they would never have even looked at insurance, and now it's like three, four, maybe even top one and two in their portfolios, like ASR, NN Group. We're also known for Ahold Delhaize, Walters Kluwer, Chisnara, Strap-on. Remember Strap-on?
Yes, exactly.
Otherwise known as Snap-on. But we joke about this, but we did get a comment to say that it is now one of their gems in their portfolios. So yeah, it's quite humbling actually when you see that, when you talk about companies
Yeah.
and then you're bringing new companies out there and people are relaying, and actually they probably know more about them now because they look at them a little bit deeper sometimes, and it's I always find it fascinating, I
And
have to
here I
say.
am, still having my purchase order on Strap-on for $69.
I mean, we missed. I mean, it was our own fault because it was brought to our attention, I would say, three times before we even looked at it. And if we looked at it the first time,
Yeah,
it was quite a decent yield, quite a decent
yeah,
price, and we would be sitting here laughing instead of making jokes about strap-ons. We would have made a shit ton of money, but
yeah. But I think we
there's the
we,
fun
we
in
went
that.
deep on that one, right? So.
Yeah, we did. I can see the mood you're in. So before you get giddy, before you get giddy, we'll move on to the news of the week. We've got quite a bit to get through. And the first one is, I know you spoke about this on social media a little bit, I've seen, but Novo Nordisk have ditched Hims and Here's partnership, and both of their share prices were affected by this. But what actually happened there?
Well, a month ago they actually announced a partnership, and it's a tricky one because what Novo Nordisk is trying to do is trying to make their access to their products much more accessible. So they were thinking like, let's go with a very popular telehealth platform that's known for getting the GLP-1 kind of products.
Yeah, of
They had a
course.
lot of compounds because compounds were allowed by the FDA because simply said Lilly and Novo Nordisk had an issue with supplying enough. There was too much demand uptake and they didn't have the manufacturing ready. This is done now, and Hims and Hers just continues to sell these compounds, and it's very dodgy because there is an escape card that you can pull that in certain circumstances a certain formula may be used for an individual, but they just continue to sell it. So I'm sure that Novo Nordisk will sue the hell out of everyone there
Yeah,
because they have a patent and patent needs to be respected, and there was only a temporary how is it time for compounds to be there. Now comes the interesting story where I've not made up my mind, yeah, because there's something to say for both arguments. Novo Nordisk says like, yeah, okay, we're pulling out because we can't guarantee. I would say we don't want to deal with a partner that is like selling these compounds and where the safety profile of these compounds are dubious. Specifically, a lot of stuff is sourced from China and they don't follow the same regulatory standards. That's one of the arguments they make. But then you have Hims and her CEO saying like, yeah, guys, we don't want to work with someone that puts a gun on our head telling us how to do our business. This is actually the whole thing why we started this company, because this is how big pharma does business. And we know what the pricing is in big pharma companies that we all hate as well, right? I mean, as a shareholder, I don't mind, but as a citizen, you could consider pharma for those reasons a sin stock. So there's also something to say for that from Hims and Hers, right? So it's from a ethical point of view, both have a good point, I would say. But yeah, I'm of course biased. I'm a Novo Nordisk shareholder, so I would like those compounds to be out of the way so that we get maximum profit.
yeah, yeah. I mean, Hims and Her Hers was one of these darlings on Twitter, wasn't it? As a
It
growth
still
stock, so
is.
it was
It still
quite
is.
quite popular. So yeah, interesting. It's interesting from both sides, but as you said, it did give an opportunity. Novo Nordisk dropped a little bit, so there was an opportunity maybe to pick up shares if you're acquiring them anyway. But one thing I found interesting this week is NATO. There was that summit in The Hague, wasn't there? Where Trump was with. They were all probably promoting Trump to keep him on board. But aside from that, and aside from all the circus and semantics that were going on, NATO agreed to spend 5% of their budget on defense.
Yeah.
So they're increasing. I think a lot of them around 2, 3%.
Not even, yeah, but now
Not
it will be
even.
3.5% really to the military and 1.5% into infrastructure, security, these kinds of things, right?
Yeah.
It's a big one. So yeah, I think the military play stocks, let's say they went already up, right? Like BAE
Yeah,
Systems and
this
such.
is already priced in.
Yeah. And I'm just wondering like where it will be invested in infrastructure and security. Is this a place maybe for some technology stocks or maybe something in the chip industry when it comes to cybersecurity? That'll be very interesting there as well to do a little bit more of analysis on to see if there are some dividend stocks also in this area that can
Yeah.
benefit from it. Yeah, but I think just generally the military stocks they went already ahead of themselves. So it sounds all nice on paper, and I think it needs to be in the next 5 to 10 years.
Yeah.
What we
Yeah.
have seen in the EU is that countries put their signatures there, but then don't adhere to it. We have seen that also with the 3% deficits.
Yeah.
Yeah,
It's
the
quite
South
quite
European
slow.
countries have an issue with that, France as well. So I wonder if we will ever see this. Maybe it's just more to please Trump now, but if there will be another leader in America that's not on Europe's back, I wouldn't be surprised if we see most of the countries never hitting this.
Yeah.
Yeah, and then we have Spain, of course, right? That doesn't want to do this stuff to that extent. It's also an interesting one because it then raises the political question about solidarity in Europe and the NATO when it comes to foreign threat, right? And there's enough, I guess, with Russia, China, and all that's going on around the world.
Yeah. Yeah, it's a quite a difficult landscape to try and even piece together because everybody's got so many different aspects. I mean, the UK won't have the same exposure to the likes of Germany or even
Or
Poland that
Poland,
are
yeah.
on the border, so you'll have a different perspective. But what I find interesting is you have all this news of increased spending on defense systems. You have Trump then going absolutely crazy with what he's doing. But then in the UK, there's a lot of news around Starmer saying that be prepared for war on the ground and all this. So like it just seems like people are gearing up for something big here, and it's quite scary when you read the news sometimes. So I try and tune out, but
Yeah,
yeah, yeah, I'm with you on this one. I think defense companies are well overpriced. I think
yeah,
at this stage, so it's trying to find that gem that's inside the scope but
yeah.
outside of people's knowledge at the moment.
So if I'm a bit skeptical, let's say, towards all that's going on, I would say, like, who earns from this? And that's the military complex. So
Follow the
if you
money.
spread the news of ground troops in the UK, I mean, Russia has barely enough people to fight Ukraine.
Yeah, of
Imagine
course.
when they start entering the Baltic states and Poland. How will they ever do this?
Yeah.
I mean, I really don't know where they will get the men from, and they don't have anyone to create babies because they're all on the battlefield. The women are alone at home. So just technically, yeah. If anything, it will be via technology, via cutting the cables, these kinds of things. But I find it hard to believe to see a war on the ground in mainland Europe with Russia. I find that really hard to see. Really hard to
Yeah.
see. I think their army is not strong enough, not big enough. And yes, we need to maybe increase budgets and increase military personnel to scare people more off. But I think there's also a lot of just scaring people going on. So there's more willingness to support politicians to open up the wallet. But in the end, I think the people that really earn from it is the defense companies and their owners.
Yeah, probably Trump and his buddies, if
Yeah,
I'm honest with you,
yeah,
which he openly brags about as well.
exactly.
There was a piece of news that popped up today on one of our groups, and it was Unilever are paying 1.5 billion for a men's grooming brand called Dr. Squatch. So it's really to complement their personal care
Yeah,
brands. Now, I don't know much about this company. It was I think it was a private equity firm
yeah,
that they're buying it off. There's not much details around how they're paying for this or how they're purchasing the company. So it's going to close probably late this year, pending obviously the regulatory approval. So, but what are your thoughts on this? Is it an area that they should be going after? I mean, I did a little bit of reading, and all I got from Dr. Squatch is that they made homemade soaps.
yeah. I guess if they can sell enough to jails, it could be really interesting.
1.5 billion worth of soap to jails.
Yeah, how many people are there in a jail nowadays?
Yeah,
Yeah, no,
yeah,
but look, I think with these kinds of things, right? It's probably an attractive brand. I never heard of it like you, but what if they can put this for premium pricing? I mean, what Unilever has, it can buy such a business for 1.5 billion, and then if those have high margins, they have the economy of scale. They can just
yeah,
push it to every supermarket everywhere, and they can earn tons of money of it. So it's
yeah.
really about the margins in such a product, and then the question, because for instance, Squatch on its own could probably not reach such a level
Of
of
course.
scale. So that's the
Yeah.
opportunity here.
Yeah, and if you think about it logically, what Unilever are trying to do is move away from the slower growing growth
Hmm.
business,
Yeah,
slower growing food business, not growth
yeah,
business, and more into personal care because that's where the margins are. And you'd expect if they're buying a company like this, right, this men's grooming brand,
yeah,
then I would expect them to be a premium kind of product, if I'm
yeah. With
honest.
a lot of influencer marketing. So that's also
Yeah,
nice to see that Unilever is going a little bit into that space.
yeah. So to me, from without knowing much more details, I think it's a decent move for them, and it kind of complements their Dove Men Care a little bit.
Exactly,
So
exactly.
yeah, you can tell we're not well groomed if we don't know a company like this.
No, no, but maybe they also don't sell it in our areas.
Yeah, true, true.
They sell
Uh,
it in the EU, they say.
Primarily targeting Generation Z men, it says in the Financial Times.
Do they shave?
I know Gen Z, I don't know what they do, but I mean, we're millennials,
Yeah,
so
millennials are a little bit the ones that are more like the hipsters, right?
yeah,
So
we're
maybe
hipsters. We're
these are again the baby faces, and that's good.
Yeah, we're not the target market, which is why we didn't hear about them. But yeah, interesting move. And then there's been takeover talks, and one of the big ones in our Facebook group, I think it was Facebook, was Shell and BP. So Shell are poised, or there's talks of them taking over BP.
Yeah, which is really interesting, and we spoke about not too long ago. Yeah, because
Yeah,
that was also happening there. But actually, Shell came with an official statement, and thanks to also for the person putting that online in one of our groups. I think it was Discord. And what Shell said in response to recent media speculation, Shell wishes to clarify that it has not been actively considering making an offer for BP and confirms it has not made an approach to, and no talks have taken place. This is a statement to which Rule 2.08 of the code applies, and accordingly, Shell confirms it has no intention of making an offer for BP. As a result, Shell will be bound by the restrictions set out in Rule 2.8 of the code, which means they cannot do any takeover attempt in the next 6 months towards BP. So at least for 6 months now, we're good. But still, what I will be doing for our Sunday newsletter, I will write a small piece of what I think a joint
yeah,
valuation, or how it would look like for Shell, and what a reasonable purchase price would be for BP.
yeah. Nice one. I look forward to reading that when I'm sitting on a sun lounger in Turkey.
Nice,
Uh,
nice, nice.
And then the last piece of news is around this big, beautiful bill. And we know Donald Trump loves his big, beautiful bill. But there's a section there about Section 899, which is such a weird, I hate odd numbers, but it's such a weird number.
Why
But
not 900? That's the whole
yeah,
question I have
why
in my
not
mind.
900 or
Yeah,
888 or
yeah.
something? But this has been or proposed to be removed from it. But what is it?
We spoke about last time. This was that they wanted to implement every year 5% more tax, dividend tax, to
Yeah,
foreign shareholders, on top of what the treaty mentioned, as kind of a a tariff towards us, let's say.
yeah.
So, but I think they came to the conclusion that if they would do that, that it would harm the U.S.
Yeah,
Let's say
this is all thanks
economy.
to Senator Crapo, which I thought was a great name.
No, did you say it? Yeah, I thank Senator Crapo. you, you don't make this up, right? You don't make this up.
Yeah, so look, our investments are safe in the US for now. We don't have to worry about selling or getting rid of our portfolios or diverting if we keep the withholding tax the same. And
Exactly.
thank you, Senator Crapo, for helping us with that. Dividend hikes. There's only two that I've seen this week, and Kroger hiked their dividend by 9%, which is not bad. And General Mills with a 1.7% dividend hike, which is not bad. This week, we're talking about dividend growth investing in 2025. Is it still the single best investment strategy? And we spoke about this, I remember, back 2 years ago in 2023. It was episode 144, if I remember correctly. And at that time, I actually listened to that show just before this, so as I could remember what we said, so we could not maybe contradict ourselves a little bit, but at the time we were saying about rising income over time, lower volatility, compounding, and patience, and all that fun stuff with dividend growth investing. But why should we revisit this now? Like, why should we talk about it now?
So, in my opinion, it's just good to check from time to time if what we are doing is still the right wealth building methodology. Um, of course, you need to stick to your strategy, because changing your strategy is like a bar of soap, right? Maybe the Squatch one
Yeah,
here, and
the premium one.
it will impact your returns. But a lot happens all the time, right? And then it's a time for growth investing. Then it's a time for dividend growth investing. Now everyone seems to be again on technology, and it confuses people. Yeah, it really
Yeah,
confuses people what to do. Dividend Runner also really made a nice picture, a nice strategy, tier four system, anchored around the all world ETF, then the VanEck dividend ETF, and then some
of course.
single stocks, right? And I really liked that what I saw because he came to the conclusion like he lies awake at night from having too much of his portfolio into single stocks. So I think he really found out something that fits him. And I know he's been pivoting a bit over the years, but still making progress. And I think many people have this in their mind. And therefore, I think it's good to revisit from time to time like, is dividend growth investing really still the single best investment strategy?
Yeah.
And yeah, I would be the last to say that I'm not biased, but yeah, I would love to really go into this and see if it changes our mind.
Yeah, I think so. I think so. And then you think about over the last 2 years, a lot has happened. When you think about it, you've had inflation, you've had interest rates, you've had wars, you've had canals closing, which has affected shipping all around the world. You have Donald Trump, who's affected the markets. So there's a lot of variables here that have affected the markets. And maybe at the time we would have thought, or people would have thought, that there was a prolonged recession going to happen, which would maybe crash the
Yeah.
market a little bit more than it has. But we've seen a lot of volatility over the last couple of years. So I think it is actually a good time to reflect on and see how the strategy is working in this type of environment, and whether we're still comfortable with that.
But do you really
Uh,
felt we have a lot of volatility? I mean, what we saw in March, April was probably the largest drawdown in many, many years since COVID.
yeah.
But for the rest, it always feels like we in the rear mirror, it's very quick there. Like who still thinks about April now?
Yeah, it does feel quick whenever we have it. In the moment, there's always that fear that it might be prolonged, but it's always been like a week or two, and it's
Yeah,
gone again. It reverts back. But in that moment where you have all this bad news happening, like the start of the Ukraine war, for
yeah,
example, nobody knew how that was going to play out. You had sanctions on Russia. There was European companies pulling out of Russia. Remember,
yeah,
some American companies as well. So we didn't know how that was going to play out and how that would affect a lot of our companies. Then you had obviously these tariffs at the start
yeah,
of the year, and that dropped the market quite
yeah,
hard,
yeah.
if you
The tariffs
remember.
definitely.
Yeah. So over the course, there's always been these little few
Yeah,
bumps in the road that may have been a trigger into something
yeah,
more,
true.
but in the end, it didn't really play out that way. And we'll get to that in a bit, because I actually have a chart here of the comparison since we did this episode last time
Yeah,
to where we are now. And I compare. I don't like to compare, but I've compared it against the S&P 500 because that's the benchmark. And as dividend growth investors, we're always told we can't beat the S&P 500, and it doesn't work as a strategy. But spoiler alert, I have beat it by 2% in like, it's not a lot, but I still
yeah.
beat it over that period of time. What you will notice in that chart is, and I'll try and maybe post these on YouTube. What you'll notice in that chart is my income, my returns is quite steady. It's just like going up and up and up and up. There's one or two bumps, but they're not really noticeable. But if you look at the S&P 500, there's at least three that I can see that have been quite large, particularly the one back in February of this year. So it's been smoother sailing as a dividend growth investor, I would say, rather than investing in your Teslas,
I can
where,
see that. Yeah,
yeah. So you see, like, I know someone working in the place I work, and their strategy is to invest in Tesla, just in Tesla,
hmm,
and that's worked out fantastically. I have to say, over the course of his investment journey. And I haven't spoke to him recently, but the last time I spoke to him was probably about 3 or 4 months ago. He had never sold. He didn't
yeah.
plan on selling. But imagine owning one company, and the share price in that is based on what the CEO says in social media every now and again. I mean, I couldn't sleep well at night with something like that. I don't know how you feel, but I mean, if I had 250,000 in a stock like that, I don't think I'd sleep. I don't think I
So
would at
tell
all.
me, you're married with one person.
Yep.
If you would ever divorce, how much would it cost you?
Probably half of everything I own.
Yeah, exactly. So you've got a lot of wealth in a single individual there.
I
The
do,
only
but a
difference
single,
is you know her more than Elon Musk.
I trust her. I
You're not
trust her, not
sleeping.
just.
You're not sleeping with Elon Musk. Maybe if you did, you would have you would have more trust.
Maybe if I was going to get half his wealth, I would
Oh
be okay
yes,
too.
yeah,
Yeah.
exactly. I would screw him over.
Put a ring on it, Elon. Put a ring on it.
Yeah, I think he would only do it if he could get a baby from me.
Well, apparently he has a lot of children. I didn't know this
Oh
until
my
recently.
God, yeah. And there was also this news about this CEO from Signal, I believe. Or who is it that has 100 babies?
What?
Yeah, there's one of those billionaires with 100 babies that wants to, because he's a sperm donor. I think he's like several babies himself and then like up to 100 other kids registered as a sperm donor. And he wants to give everyone an equal share. And I believe all of the kids will get more than $100 million.
This is the CEO of Telegram.
Of Telegram. Yeah, this one. Yeah,
Telegram.
yeah, yeah,
Yeah.
exactly.
Oh boy. Oh,
Yeah, but
I have two.
imagine he's
I have
sitting at
two
a
kids. That's a
sperm
lot.
bank there and just jerking off as a billionaire all the time, putting, and then, and instead of getting paid for it, he needs to pay more than 100 million per orgasm.
Wow. I mean, he has 6 official children, but
Yeah,
his plan is to split the wealth between all these children.
yeah, exactly. I mean, that's that's expensive, pink Rosie and the Five Friends, right?
Well, I have a good investment strategy for my wife. We're going to the sperm bank tomorrow. I'm retired.
I like it. I'll join you.
It's so easy. Never mind. Hey, forget this. Dividend investing is gone. It's gone. We know what
We'll
we're doing.
change our strategy. Forget about dividend growth investing. We need to figure out where he's depositing his sperm.
Yeah, exactly. Exactly. That's what we're doing.
Okay, the episode is done.
But seriously, like what have you learned over the last 2 years differently than when we spoke about this before?
Oh my god, I
What
really can't answer that now. You need to answer first because I'm still thinking about like what am I doing here?
well, for me, one of the biggest things is I remember on Facebook we brought in these badges, and you can pick which 10% towards FI, 50%, 100%, and so on. And we've got quite a few that have reached financial independence, and we're lucky enough that we get a couple of emails off a few different people who are in that position, and they do lots of different things. Some people travel, some people don't travel. I can see you still laughing. But for me, what I've learned is that there's people who have done this. They give us lots of advice on what they did all the time, but it works. And the proof is in the pudding. And I've yet to meet a growth investor, and I'm sure there is, 'cause they're not in our circles, but I've never spoke to one that has actually retired from that and how they live off that. I
Mhm.
have yet to speak to one. And I think actually it would be quite interesting to have someone on the show if anybody knows someone in this position that is a growth investor or still a growth investor, but are living off their investments and how they manage that. Because it'd be really interesting to speak about that. But from a dividend growth perspective, we have lots of examples of this happening. And I think that for me, it's the biggest comfort. And I'm also, 3, 4, 5 years behind you in the journey. And it's like I have a guide because I can see where you were 5 years ago, which is probably where I am now. And it's like I'm following in lockstep to where you are. So it's, yeah, I think the biggest learning for me is that there's lots of people out there that have done this, that give us advice, and it works. And it makes it easy for me then to stay the course. Obviously, the podcast, the newsletter, all this helps, but actually speaking to real people, I think, is the biggest benefit of that.
Yeah, I think so as well. I mean, I went from probably 55% to almost 75% of dividend expense coverage.
The,
So, I mean, that's insane. That's really insane, right? When you think about it. So, because, modern theory, or actually what I just learned at school and business school is it's a simple fact. If interest increases, stocks go down. We have seen it a little bit with real estate investment trusts, right? They are yet to recover fully,
yep,
but I haven't seen it in my portfolio.
no,
Yeah, it just chugs along, and maybe it's because I don't have companies that are overly in depth in my portfolio. I just generally have the majority of the companies in my portfolio have strong balance sheets, and they are not so sensitive to interest rates. So maybe that's also one important thing when we talk about dividend growth investing. We are not talking about dividend investing and just going blindly for the dividends. We need companies that have a safe dividend profile generally are able to grow their dividend through thick and thin, right? Whatever the weather
Yeah.
is outside. And that's what I see also in my portfolio. My companies just continue to chug along. Some do it better, others do it worse, but on average, it just moves along, right? And I think that's so powerful about dividend growth investing. If you focus on companies with a healthy balance sheet, enough catalysts that are bigger than, let's say, are more provide more opportunity than the potential risk. If you start looking at it from that way, there are not also too many dividend stocks that you can buy, dividend growth stocks. If I have 3 to 5 each month, that's a lot. Yeah, that I
Yeah.
feel like, okay, those I want to buy. Watch lists are not easy to compare. People think that I just shake my arm and 30 fall out of it. No way. I've got maybe 30 or to 50 stocks that I would like to own, but how many of those are in a given month available to me at an attractive price, right? Really not a lot. And in times when this stock market is doing really well, it's usually the ones that have a broken thesis against them for why they are trading now. Think now as well about Novo Nordisk, right? The
Yes.
whole competition with Eli Lilly, United Healthcare, right? But where are the high quality other high quality dividend growth stocks like Costco, Ahold has and Schneider Electric, where they feel continue to feel expensive, too expensive for us, and that hasn't changed over the last 2 3 years, right?
Yeah.
Either, and which tells me again that if you think about it, there's a lot of growth in dividend growth investing. You don't need to
Yeah.
go for the high yielders. If you go for the Visa of this world, the Costco, the Home Depot, Broadcom, all of those have been doing very, very well, and ASML as well. So, um, what I like more about dividend growth investing, therefore, is that you filter out the stocks that are still too much in the speculation mode in the early growth. For me, it's a little bit more speculation because the risk is much higher. The reward is potentially higher as well, but also there's more downside. And this for me, therefore, if you really want to care about your principal and your money, I think generally speaking it's better to be in the business of stocks that have a proven track record, have a certain
Yeah.
maturity, what we call blue chip stocks, than being in the early days of companies around the IPO time and the few years after that, because that really requires you to understand the business much more better than you could. And if you do, like, you need to really educate yourself in the industry much more than you need with our investment style. And for retail investors, it's really, I think, easier, because how much can you really understand some of the hype tech companies there? You really need to be inside that company or inside the industry, inside in that bubble, to really understand what's happening there. And usually it's hard for us to get all those data points, specifically if you need a diversified portfolio.
Yeah. Yeah. I think one of the biggest pivots, I won't even say pivots we have, but our focus has shifted over the last few years onto dividend safety more so than
Mm,
anything else. I
yeah.
think that's been our biggest shift, at least from what I can see. And I mean, those that read our premium newsletters or any of our newsletters will know that there's probably five key components to that. We
Yeah.
look at how the company has grown historically, because I think that's always important. But then the rest of it is really, what are they doing going forward? What are their growth prospects like? Have they shown a commitment to the dividend? What does their balance sheet look like? And can they actually afford the dividend? And I mean, there was an interesting study that I came across when I was researching for this, and it's we'll post this in the description. But there's a PDF from a company, RBC Wealth Management is the name of the company, and they've done this creating wealth through dividend investing, and I thought it was a really interesting piece. And what you'll see actually is over the last 50 years, 72% of the S&P 500's total returns came in the form of reinvested dividends. I mean, that's quite a
Yes.
number. That's like three quarters of the returns of the S&P 500 has come from dividends. Now, if that doesn't tell you that dividend growth investing works, I don't know what will. But what's really interesting is that when the market is flat or it's underperforming, like we had this last decade with the US companies,
Yeah.
that's when dividend investing really, really turns on the style. And there's a couple of different charts that they've given. I'll try and talk through a couple of them, but I mean, you can see 2001 to 2010, the dividend contribution to the S&P 500 index was 131%. It exceeded 100%. The average is around 50%. You can see the last 10 years actually where it's been a little bit more growthy. So 2011 to 2019, it's been a little bit more growthy. It only returned, I say only, but it only returned 24%
Hmm.
of the total returns. So you can kind of gauge from that what kind of environments dividend growth investing works in, but you're still generating a lot of returns from dividend
Yeah.
growth investing
And the
in that
decade of 2000, 2010 is generally known as the lost decade.
the last decade.
And many people predict that we are also at the brink of a lost decade here because of the valuations.
Yeah,
Makes sense if you follow the rational thinking here of the current multiples. At a certain moment, you would expect multiples to come down, which in this case assumes that earnings would grow at a at a flat share price overall.
yeah,
And there must come a time, I think, because it feels so weird to pay 30 times multiple for the average index.
yeah, yeah.
Yeah, there's a lot of growth implied in that.
I mean, there's too much growth in employed in that, and like if you go back historically, you can see the last time we've hit a period like this, you can see there's not a lot of growth in the S&P 500, but that's where dividends reinvested really takes on a life of its own. But I want to end the piece on this research about their last paragraph, and I thought it was really interesting. I don't know if you've read it or what your thoughts are, but they finished it by saying the current environment, including baby boomers, need cash to help fund retirement. Historically low interest rates and high levels of corporate cash on balance sheets, and in our opinion, this will bode well for dividend paying and dividend growing stocks. Plus, for younger investors, owning stocks of dividend paying and dividend growing companies and reinvesting the dividends is a great way to create wealth for the long run. I thought that was really interesting.
Indeed, and makes more sense.
Yeah, of course it does. I mean, we've spoke about it on the show. We've got a lot of people from this baby boom age coming up to retirement. They're going to need to get that cash.
Yeah,
If they're not dividend payers, if they're investing in the growthy stocks, they have to pull it from
the
the
four
company
percent
itself.
rule. Yeah,
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 um, maybe more. So I thought that was interesting. There was one other interesting part in this, and it was talking about dividend cutters, and we touched on
yeah.
this. But what it said is that high payout ratios often lead to unsustainable dividends and eventual dividend cuts. I mean, again, it's probably circles back to our focus on quality. What do we look for? Strong balance sheets. Can they afford a dividend? Do they have a commitment to the dividend? And I think, yeah, I like this piece. It kind of reaffirmed what we probably do and what we think.
Yeah.
But it's good to actually see it wrote down in an official paper.
Yeah, and it's interesting, right? We are also, I will not share the name, but we're also sometimes in conversation with someone in email who's retired on dividends.
Yep.
And he reached out to us also saying, like, based on the question, like, how will you shift from saving to spending, right?
Yeah. Yes.
And he shared that at the moment he can't even spend his dividends. Yeah. So, and then the capital just continues to grow. Now, if that's not a good evidence of the power of dividend investing, that you don't need to touch your principal, you don't need to sell, and you're still having an issue spending your
I,
money. And he mentioned that they are flying business class and everything already, so they
yeah.
did
Yeah.
those
Yeah.
little
Yeah.
things.
Yeah. I mean, I read that email 3 times before I wrote back. I just kept reading it. It was like, am I right?
Yeah,
He keeps earning more. He's spending more, but can't spend what he's earning. So,
yeah,
uh, of course, we know the type of lifestyle that they have. They travel quite a lot, and it's always inspiring to see that. But it's yeah, I mean, we don't have to pull this 4% rule. We just have to leave it sit there, and we'll never be able to spend what we earn, which is quite inspiring, I have to say. But yeah, for me, dividend growth investing is still the best investing
the single
strategy,
best investment
the
strategy.
single best investment strategy, and for me, it definitely is. We've spoke about it lots and lots of times, and
And
yeah,
especially for me, because I can sleep well at night. I really don't perceive stress over 11 years that I've been investing, I've not had any stress. I didn't need to worry about my Katie Wood stocks in 2021. I didn't need to worry about the fluctuation of Bitcoin and this thinking deep down in my head, is it really an asset? Yeah. So
Yeah.
I didn't need to worry about what, I mean, there was even today, there was a tweet again about calling out quality compounding.
Yeah.
This guy on Twitter who in 2022 posted a tweet about Fundsmith stocks and saying like, look at these quality stuff in here, and then you look at the list and you will probably not want to own almost anything of that, right? And we have seen this a lot. Every time when there is a growth hype, all these stocks come up that don't have any history, but they are in the hype, and people jump all over them. And then you look at them 2, 3 years later, and you see like very poor price charts. Only a few not. And the issue I often see there is that people have kind of a survivorship bias there because they look at the stocks with perfect price charts until they haven't
Yeah.
anymore. And if there's nothing behind it with a strong balance sheet or dividends, you're on your own there with the price.
Yeah. Yeah. I mean, look, we might have missed out on someone like Palantir. So we might miss companies like that because that's been exceptional, and yeah, we can't argue against that. But then look at someone like Peloton. It was a bike with an iPad. And this was one of the great. I mean, everyone's saying it was a quality company. It's a great growth story. It's a great company. And what's missing for me with these companies is what you said is the balance sheet. It's really difficult because they're so young and so early, and they need to reinvest that money. Sometimes they need to take on a little bit more debt than what we would like in order to grow the company. Sometimes the balance sheets don't really stack up to what the company is. Now, if it works out great. But when it doesn't work out, it's like you said, you're left there holding a bag with a pretty shit balance sheet. Look at Neo, for example. They were meant to be the next Tesla. I don't know where the share price is now. It was 30. I think it dropped to 5 at some point. But I don't know where the conviction comes from that, because when the growth story plays out, or once, because we live in a fickle world where consumers change nearly every 5 minutes. So when people change their minds and they don't want to own a bike with an iPad, what do? You have nothing to rely on.
Yeah,
You're
but
just losing
others will
money.
just call us incompetent, and they will say that dividends are tax inefficient.
Yeah, the tax comes up quite a bit, but you're taxed on everything. You pay tax
Yeah.
on everything. So if you sell, you're going to pay capital gains tax.
Yeah, and that's the same as saying going to your employer saying like, no, I don't want that salary because I need to pay more tax then.
Exactly.
Yeah, that's what we're
But
saying, right? No,
uh,
please don't double my salary because I really have to pay more tax and I hate tax. So please keep it what it is.
yeah, but I mean, of course, you don't pay tax if you hold a company and you don't sell them and the share price has gone up 100%. Great. But what when you want to live off that, you're going to have to pay tax at some point. It's going to cost you
Exactly,
money at some point.
exactly.
So we just paid up front, I think.
Yeah, that's true. Which does, to in fairness to the mathematicians, it does impact compounding
Yeah, of
from that
course.
point of view. But I think the compounding is strong with dividend growth stocks because those are typically stocks with a high quality business under it, which is not easily
Yeah.
disrupted. Those are slow compounders, took many years to get there, not easily disrupted by new technology and technology entrants. Look at Google now, just started paying a dividend. It's being attacked now by OpenAI. I really think
Yeah.
that, I mean, the whole community is almost saying like undervalued, undervalued. They scream it, but I mean, I posted a tweet today that my the visits to my blog European DGI are dropping
Yeah.
while I'm still ranked in many places number one or number two. That didn't change, but I know that ChatGPT and those models, they answer questions, so you don't need to visit the website anymore. Yeah. So, and I think that's and a lot of the search queries that went to my blog were typically what are the top European dividend stocks. Yeah. So all I'm trying to say is like, while Google is being attacked, it took 20 years to come there, and they started to diversify. They saw that they spend a lot of money on that, right? On many, I said moonshots and everything, but they do have Waymo now. They do have YouTube.
Yeah.
They do have the cloud business. They do have their own Gemini. So if this would have stayed only with the ads business because it was a relatively young company, their whole existence would be into question now. Now there's a large percent of their revenue is under threat, but they have enough things going on for them that puts a defense mechanism in, yeah,
Yeah.
which increases the survivorship of the company and the likelihood to pay a growing dividend. Yeah, and that's what you don't see with the younger companies typically.
Yeah. Yeah. Wholeheartedly agree. One thing I do notice though is my reliance on Google is far less. I mean, for we were talking about who had 100 babies.
Yeah.
I put that into Perplexity and it gives me that straight. I love Perplexity. It's a
Perplexity, I
great
love it as well.
it's a great search engine, and it'll give you like where it gets the sources from. So if you
Yeah.
want to read deeper, you can just click it, and it's so easy. So yeah, I've noticed that myself with Google. But I get your point. I get your point. Younger companies just don't have that cash flow that like that say
Yeah, but
Google
also
have.
not the diversity of a business, right? And that's what all those young companies needed to do. Google as well. Google was a one-trick pony, but
Yeah,
then
of
they saw
course. Yeah,
streaming, TV streaming, and now YouTube is the biggest streaming media that exists in the world. They get a lot of ad revenue from that as well. Gemini now is doing really well. I'm very impressed with Gemini compared to ChatGPT at the moment. And if you look at Gemini and ChatGPT, there's a lot of white space on the screen. Imagine
yeah,
now that you start searching on terms and then you start seeing the ads popping up in this white space. That's where the opportunity is. If you look
yeah,
at how many people are using ChatGPT right now, hundreds of millions, there's a lot of real estate there on that screen that they can start selling. And if you look for I said, what you just search for the 100 babies. You could show
Perplexity.
diapers there. You could show maybe the sperm banks there. I think it can even be more intelligent because you're asking questions and therefore they better understand the intent of your search and can do better advertising, targeted advertising. They know your whole personal history, specifically those people that are counseling also on the LLM to get psychological advice. So they know your darkest secret, potentially even. So imagine the advanced targeting you can do in advertising, which I think would result in advertisers paying up much more for what they do for a general search engine. So
Yeah,
there's a lot of opportunity in that space, and if again if Google is able to uh, you know come out as a winner in this because I think things will become a commodity, these LLMs, pretty soon already. There's already so much out there. So it becomes more like what's the space where people want to enter it. And at the moment, if you look at statistics, most people still go to ChatGPT, even though Gemini is at this moment in time probably even a bit better. Yeah, but Google is not too late to get Gemini in everyone's minds. I think they're doing
yeah.
quite a good job. I'm very impressed with how they started to step up because remember Bart, yeah, this ugly, ugly name.
Bars. Yeah,
Yeah, and I felt like, oh my God, if this is what Google comes up with, and then I remember the CEO took the smartest engineers out of the company, said like, stop the hell you're doing. There's only one thing we should do here is AI, AI, AI. And look at the turnaround they've done as a company over the last year. It's amazing.
yeah,
So a lot of opportunity still for Google, but their ads business is really on the threat, in my opinion. And that's still
yeah.
where 57% of the revenue comes from.
Yeah,
So
a
it's a
lot,
lot.
over 50%.
Yeah.
Yeah, yeah. I don't know about you, but I've never taken to ChatGPT. I use Gemini
Yeah.
and Perplexity. Gemini I find really good because we do a lot of stuff
Yeah.
in G Sheets,
Yeah.
and it's really good at helping with like grammar. I could just
Yeah.
say tidy this
Yeah.
up, and it writes. Sometimes it writes a little
Yeah.
bit robotic, so I have to rewrite it.
Yeah.
But it will definitely fix my grammar. So
So for me,
I do like
ChatGPT
it.
has the first mover advantage on me. It just created a habit for me to open
Yeah,
it up in the browser first. I need to start rewiring a little bit more towards Gemini because we use Gemini a lot at work as well, and that's where I'm starting to be impressed now. But I think that's why you see the statistics still so high because OpenAI had the first mover advantage, like Alta Vista at the time.
yeah,
Yeah.
yeah,
So now the question is, can Google, um, hook it into their ecosystem so much so that we forget going to ChatGPT and start seeing ChatGPT as something old? I mean, it's game on in this industry. It's very interesting to see. Don't ask me to predict who will be the survivor out of this. I think it's pretty much a known. It's an open space, but it's very nice to see. But Yeah, I'm really not bullish on Google because of the revenue and the threat, but I'm not selling either. I'm just holding at the moment. I mean, I've got a few shares. It's hardly a blitz in my portfolio. So
Yeah, too hard to predict. Remember back. This will show you how old we are. But remember back when we had DVDs and you had this
yes,
Blu-ray and was it
hmm
HD DVD or
yeah, yeah,
something,
yeah,
which
yeah,
was red, and everyone's which one is going to be better.
yeah.
And Blu-ray eventually
Did
came
it?
out the winner, but
Yeah,
only for a short time. So this
yeah.
is
And we
what
had
the AI world.
was it VH Max or something like that, and then the videotapes before that.
Oh yes, yes,
Betamax it
but
was.
yeah,
Yeah.
yeah. Now we're really going back. I mean, there's going to be
Yeah,
young
well,
listeners
Commodore
going,
64, right? And then Nintendo and
Atari,
Atari, Sega. Yeah.
Sega,
Ah.
yeah,
Were you a
Sega Mega
Sega
Drive
fan
one,
or
two.
Nintendo?
I had both.
Oh, both. You couldn't choose then already.
I had both. No, do you know what? We were lucky because I used to
Yeah.
share a room with my brother, so we used to make an agreement. At Christmas, I would ask for Nintendo. He would ask for Sega Mega
Ah,
Drive, and we play. I actually still have the Sega Mega Drive
wow.
up in my attic, and
Yeah.
we took it down maybe last
Yeah.
Christmas, and we had it. There was 100 games, and the kids were playing it,
Yeah.
and they kids are so good on
Yeah.
computers these days. They struggled.
Yeah, I know. I
They,
know.
they struggled.
I've got the old Nintendos as well, and my kids tried it, but I was really beating them very easily.
Yeah, I loved it.
What I find a pity is that I don't have a Commodore 64 anymore. I would love to show my kids Prince of Persia.
Yes,
That was an amazing
yes.
game.
I'd say it'd be hard to get one of those now. But yeah, that
Yeah,
was
you have the
that was
emulators online, so you can play, but it's
not
not
the
the
same.
same. Exactly.
It's not the same. It's not the same. I mean, anyone that has owned these consoles before and try play the emulators,
Yeah.
it's never
No,
going to
it's
work.
never no. True.
I played the new Street Fighter on it was on PlayStation, and I
Yeah.
was like, this is rubbish.
Yeah,
I don't
yeah.
like this.
Same like Mortal Kombat 3D. We
Mortal
we played it
Kombat,
in
yeah,
2D. Yeah.
yeah,
You had this was oh man, Fatality. Yeah, remember that you
yeah,
had them on the
yeah,
knives and it was
yeah.
already very bloody and everything.
Sub Zero
Sub Zero, yeah,
edition.
that was my
Yes,
favorite. Yeah,
yeah.
exactly. Yeah, I
Good.
mean, Nintendo, by the way, is doing well. I believe also pays dividends. Nintendo Switch 2 is doing really well. I bought my one myself. Actually, love it. It's great.
Yeah, I mean, we spoke. I had Dazzy Mike on the show when you were off on vacation, and we spoke about different companies outside of maybe Europe. There was some in Europe, but unknown companies, and there was lots of Japanese companies that came up offline that we could have spoke about. And Nintendo was obviously up there as one of them. It's such a great company. It'd be one just to own for nostalgia, really, more so than anything
Yeah,
else.
true,
Like
true.
Ferrari. Yeah. But anyway, to conclude, is dividend growth investing still your number one investment
Yes,
strategy
of
for
course.
2025?
110%. 110%.
So you're not changing your name anytime soon. That's good
No,
to know.
no. And what I forgot to say, actually, because I put it in my notes, my portfolio since we last spoke is 45% up since the last time we, like, episode number 44. And my dividends year to date compared to the year to date then is also 42% up. So I rest my case. I mean, growth maybe could have given me more. I know there's capital deployed here as well, a lot of reinvestment as well, but 42% more salary in 2 years from my dividend income. I mean, I take it anytime.
I mean, you're not going to get that in
At
the
work,
corporate
no.
world. No, no,
Ah.
unless you're unless you're CEO.
Yeah, or unless you're in a very fast track.
Yeah,
Yeah,
yeah. You're not going to get that in my role. Let's put it that way.
yeah,
Let's
I see what
let's
you
let's
mean.
finish on that. Okay, we've only got a couple of questions. Mainly, we got loads of responses in terms of what people remembered, some nostalgia, lots of thanks, which we appreciate. But we have three questions, and I'll start with Des Mikey's, and it is never waste a good crisis. In 2020, we started this podcast. But what he's really curious about is what do you expect from the next 5 years of investing?
Yeah, I think what I mentioned earlier a little bit. I think that we will see a little bit less growth,
Yeah.
um, with a catch there, unless they start aggressively lowering the interest rates because it will have an influence on the market. And then I'm talking about from 5% to 2% within 1 or 2 years, because I
Yeah.
think that will be a big boom for real estate investment trust, for free money floating in again. So but that will keep the multiples on these levels. But it will also influence earnings there, although you could say there's a little bit of synthetic earnings in there. Secondly, AI. I see so many productivity opportunities due to AI that I think companies can do with less workforce. So it will put a pressure on society, but for companies to increase the operating margin, I think there's an opportunity there. Though I think it will take a little bit longer time to see this coming to fruition, and that's why I think over the next 5 years we will see less growth in share price or in stock market gains compared
Yeah.
to what we have seen over the last 5 years.
Yeah, yeah. AI is such a tricky one for companies and businesses because you need people in place to put it in, but ultimately once it's in, you're replacing these people.
Yeah,
So it's and that's essentially what's going to happen. So I agree with you. Next 5 years, I mean, I should be approaching the boring middle. I
yeah.
would say I'll be officially in the boring middle.
But I would say to everyone, right, really start dividend investing because don't expect society to be able to look after you. I actually am more afraid that we will see because of that that if AI will have a disruptive effect on society because we can't consume the labor coming available in such a short time and repurpose it, that there will come a growing discontent towards the wealthy people, and that we will see much more taxing on capital gains, wealth tax, and everything. So they will try to harvest it from us. But still, I think you will be still better off as a shareholder than expecting society and the government to look after you via social welfare.
Yeah, yeah. That's how I feel in general. Anyway,
Yeah,
if I'm honest, I'd much rather look after myself. At least I can trust myself.
exactly, exactly.
William wants to know where you think your portfolio will be in the next 5 years.
I think I will be. I think I will be crossing the 100%. So I will be for sure financially independent. I may not even work anymore by then, and therefore at that time my portfolio won't grow so fast anymore because I will be consuming the dividends. Other than that, 5 years from now, I think it should be 60, 70% higher than where it is now. That's what I assume, just because of
Yeah,
the compounding effect in dividend stocks.
yeah. I think I should be hitting probably close to 60, 70%
Yeah,
around that stage, I would imagine. So let's see. Although my portfolio has grown quite rapidly since crossing the 100K mark way back in October
yeah,
last year, it grown
nice,
more than I
nice.
expected. So let's see. But it's all about dividend income. Let's
Yeah,
see where we go.
but you have a second
Uh,
part of the question, right? Is asking
Go for it. Yeah.
about three companies where I also will expect where they are 5 years
Oh yeah,
from
yeah,
now. So he suggests Shell, NN Group, and Sila. Shell, well, Shell is an interesting one because over the last 20, 25, or 30 years, it has been stuck in a range between, let's say, 20 euros and 34 euros. So the question is, why would it shoot above that right now? I think in 5 years from now, it could be at 50 euros, provided that it continues the buybacks. That
yeah,
also provide it is also provided that the oil price stays relatively in this range between 60 and $80, with on average 70 for long enough, because that allows the company to buy back many shares. And with current management, this will have their priority. Um, However, if they decide to buy, for instance, BP in the meanwhile, I think this could be a different story here, and maybe it will stick in the range for that reason. Because I need to do my due diligence. I will put in a newsletter, but I would expect that they would, I don't know, need to issue shares, 30% shares or 40% shares increase. So all the shares that they bought back will be reissued again,
yeah,
taking on debt, which will take increase interest rates. Of course, there will have lots of cash flow in replace for that, but it's kind of re-anchoring the stock again and putting it somewhere for some time. NN Group, I just think it will continue to compound. So if you think about NN Group at these prices, let it compound by 7% per year. In 10 years, that should double. So I don't know what the exact ratio will be, half of that, but yeah, let's assume that it will be trading around 75 euro. Sila, I know why you're asking. I've got a very small position in this one at IPO not too long ago. It's in the healthcare real estate investment trust industry, let's say. Sila is a tricky one. Let's say it will double in the next 5 years. I'm
Yeah.
on the. They still have a little bit of over dependency on a few single tenants, but I'm quite bullish on the gray aging population and the need for their facilities. They don't have a lot of debt, so I think they can grow a lot by acquisition. That's my
Yeah.
thinking here. But this is the typical, for me, high risk, high reward play in the real estate
Yeah.
investment trust. I much
Yeah.
prefer Agree Realty.
Yeah. Shell is the interesting one for me there with what you said with BP. Essentially, they'll be going back to where they were when they bought British Gas.
Yeah, yeah. As an example, yeah, yeah, yeah.
Yeah.
But of course, with much more cash flow coming in again, which
Yeah,
allows
of
them to buy
course.
back a lot, and it all depends on the price they pay for BP.
Yeah. Yeah. I wouldn't say it'd be cheap, but I'll wait for your analysis before we
Yeah, but
discuss
there's a lot
that.
of synergy, right? You can just cut out a lot of management, a lot of overhead, combine the IT systems over time. There's a lot of opportunity there.
And the last question comes from Fire Engineer. And regarding investing in sin stocks, do you avoid them because you don't want to support it or because you don't want to earn dirty euros?
So I don't avoid investing in sin stock. I'm of the philosophy that almost every stock is in sin stock. We spoke about pharma and the drug pricing, mining, dirty child labor potentially, retail.
Close business.
Yeah,
Yeah.
retail, a lot of waste, a lot of dirty supply chain. All these tankers are not very ecological. Banking, think about the moral due diligence that they have there. So so when you then only think about banks, I just don't like banks most, and that's mostly anchored in my experience in the great financial recession, and that's why I don't want to own it there. But it's very personal.
Yeah. Yeah. I'm the same. I do not a double negative, but I do invest in sin stocks as well for pretty much the same reasons. I think a lot of companies are sin stocks, and look, at the end of the day, we're here to make money, and if you don't invest in them, somebody else will. They're not going away. That's for
Yeah,
sure.
because we would enter very quickly philosophical discussion about capitalism versus communism and these kinds of things, right? And
Yeah,
I wouldn't like to live in communism. If I hear the people speaking here that lived under such a authority, then no way.
yeah. Cool. So that is the end of our show. It's the first episode of our sixth season. So cheers to you for the last 5 years. Let's hope we have another five ahead of us.
Definitely. Just
Thanks
stay
to all our
healthy.
listeners.
Just stay
Oh,
healthy.
of course, let's stay healthy. Thanks to all our listeners for tuning in, for asking us questions, for all the memories you've sent us. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.